Okay, everybody. Conan and I are both out of town this weekend, so what I'm going to do is record the podcast, kind of like I do the walk and talk for newsletter subscribers. Um, and I'm recording this on Friday morning. The market is up quite a bit. It's been an unbelievably volatile week. We had a couple of hard down days. We had the Fed raising 25 basis points on Wednesday. Tuesday, Wednesday, Thursday were all down days. And then Friday so far is a pretty strong up day. So a lot of volatility to start off May. But what we're going to look at this week, we're going to just talk real quick about the Fed announcement on Wednesday. And then I'm going to do a trend line analysis of monthly, weekly, and daily charts. And the bonus chart is going to be a daily chart of the S fund because there are basically two possibilities on the S fund right now going forward. And one of them is a really good example of a head and shoulders pattern. So we'll take a look at that. And then the regular weekly TSP fund charts. Okay, so on Wednesday, the Fed raised 25 basis points, which is what everybody expected. A basis point is 0.1%. So here was the highlights from CNBC. Fed Chairman Powell's market-moving comments after the latest interest rate hike. Federal Reserve raised interest rates by a quarter of a percentage point, right, which is the same as 25 basis points, bringing the benchmark Fed funds rate to 5% to 5.25%. So the Fed funds rate isn't an exact number, it's a range. And so after this 25 basis point hike, the range is now 5% to 5.25%. So that was expected. And what always moves the market is what the Fed says in its post-meeting statement. So on Wednesday, in the post-meeting statement, central bank appeared to soften its language on future rate increases by removing the line from the previous Fed statement. It removed the line that says additional policy firming, which basically tells the market that it's unlikely that the Fed is going to do another rate hike in July at the next meeting. In his press conference, however, Chairman Powell noted that the policy setting committee thinks it will take time for inflation to come down and it would not be appropriate to cut rates, meaning the same thing he's been saying for a long time. We're going to raise rates to a certain level and then keep them there for a long time. And ultimately, the market does not like that. So that was really what, in terms of the Fed statement, what pushed prices down on Wednesday was the press conference where Powell kind of reiterated that he's going to leave rates at this elevated level for a long time, even though the market is pricing in that the Fed is going to start cutting rates as early as the summer. But Powell's saying, no, I'm not going to do that. So let's flip to the charts. So we're going to look at monthly charts, weekly charts, and daily charts of the S&P 500. So this is a long term. Obviously, we're going back to the Great Depression here, right at the bottom of 1932. It's a monthly chart. So each one of these ticks is 1 month of price action. And this is obviously a really long-term chart. So what I wanted to point out in terms of Elliott waves, right? Here was the bottom, the major bottom from the Great Depression, right? And coming out of that, we have 1, 2, 3, 4, 5. Okay. So in the big scheme of things, that's the Elliott wave pattern going back to the Great Depression. And so the channel is pretty clear, right? We had a little bit of an overshoot of the channel back at the 2000 top. But other than that, if you connect wave 2 with wave 4 to make your bottom channel line, and you take a horizontal line and bring it up to connect wave 1 and wave 3, you have a really good long-term price channel. And so when this is really good for perspective, because when we hear people talking about, on the one hand, there are a few, but some people that are saying, hey, the S&P can get up to 65,000 or 6,500 or higher by the end of the year. You can see that how that's possible in this chart, right? Maybe not by the end of the year per se, because that would kind of be like that. But over the next couple of years, is it possible that we can come up and bump up against this upper channel line? Yes, it's absolutely possible. On the other hand, you have people that are saying, the market could come down to the low 2000s. And how would that happen? It would just take us back down to the lower channel range. Okay, it would be a very big deal, both to the upside and the downside, right? If we got down here to 2150, that's like a 50, yeah, basically a 50% move down from where we are now. So that would be really bad from from the bearish perspective. And on the other hand, we could get a 50% increase from where we are now and get up here to 6,500. And it would both of those possibilities are within the long-term channel. So this just kind of gives us some perspective, really long-term perspective on a monthly basis. If we kind of zoom in, still on a monthly basis, and we draw a trend line. So back here, here's the bottom in 2009. If we connect the major lows going back to 2009, we have an overshoot here from COVID. But the October low hit that long-term monthly trend line, right on it. We almost tested it last month, and that test of it might be good enough for support to keep this thing moving higher. What we don't want to see is the market price to get down here and break below this trend line. Okay, that's really what we're hoping to avoid. So if you're still in the stock funds, on a monthly basis, it's fine as long as price stays above this upsloping trend line. And if we really drill in on a monthly basis, we have basically a support resistance zone that's been setting up for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So basically the past year, so 12 months. So we have this support and resistance zone, and price broke above it as of April's close. Okay, so on a monthly basis, that's really good. We have what JC Peretz likes to call a smiley face here, and we have a breakout above that resistance line. So on a monthly basis, we're actually looking pretty good. Okay. If we zoom into the weekly charts, this is basically the same chart as we looked at it on the monthly. We're still going back to the low in 2009, but now each one of these ticks is 1 week of price action. So we do the same thing. If we connect the major lows, we get the overshoot again from COVID, but we get that October low, that week sitting right on that trend line. So again, what we want to see, even if the market comes down and tests that trend line again, it can still move higher. So we've been talking for a long time about this August high. We want to see price get above that August high to kind of clear resistance to keep moving higher. Or if it goes below this low, we're likely to test the trend line. And if we break below the trend line, then we're likely to go lower. Okay, so and a pretty easy way to look at it would be if this was A, B, C, this length would be the same length as this. And so that's why you're hearing a lot of talk about the 3,100 level from some analysts that expect a breakdown this year to roughly that 3,100 level. That's kind of where that comes from. Okay. So if we zoom in still on the weekly basis and we go back to here's the COVID low, and we connect the kind of the major lows of the bull market in 2021, we get a clear break through that trend line in January 2022, right? And that's what started this whole kind of bear market coming down. So all we're doing, like Con keeps saying on the in the show, you kind of zoom out and then zoom in to get perspective of what the market's actually doing. So this is where the trend line break that was a huge red flag on a weekly basis that the bear market began at the beginning of 2022. So if we zoom in to kind of still on a weekly basis, but if we connect the major highs, right, we can see how this, on a weekly basis, how this bear market progressed. And a couple important things to point out about this one. So we had a high in January, market comes down, finds a bottom, comes back up, gives us our first point where we could draw a line, right? Comes back down, makes lower lows, right? Lower lows, came back up, a little rally, didn't get anywhere near this trend line, down again, lower lows again. So now we clearly have a downtrend, right? We have lower highs and lower lows. So we're in a downtrend. Then we get the big rally in the summer last year that gave us that August high. So now we have 3 good points to draw a trend line from. Okay, and we extend that trend line out, and this is where we are so far in the extension of the trend line. But from the August high, the market rolled over again at that trend line and put in a lower low again. So we're in this long-term downtrend, okay? And then of course we get another rally in October last year. We put in another low, we get a rally back up to the trend line, a reversal off the trend line again, but this time we put in a higher low, okay? That is the first really significant kind of event that gave us the possibility that this long-term downtrend was reversing. When we got this higher low, okay, and then in January, February, this high gave us a higher high. So now we have a higher high and a higher low, and so now we have an uptrend, okay? And so the higher highs and higher lows are really important. When we broke above that trend line right here, that was additional confirmation that the market direction was shifting, right? It was changing. We barely have a higher low here, and last week we put in a closing week high above this high. So on a closing basis, as of the close of last week, we have still higher highs and higher lows. Now it's overall starting to flatten out, but we're still in this uptrend as long as we have higher highs and higher lows. Right? So that's on a weekly basis. All right. If we zoom into the daily chart, same kind of trend line analysis. If we start at the top here in January 22, we're just drawing kind of shorter term trend lines. So we had the first move down, a correction took us back to that point, move down. So now obviously we have lower lows, the correction back up to that trend line again. Now we have 3 points to connect, and we just extend that line out. Market rolls over again, lower low, comes up to that trend line again, rolls over, and gave us basically a double bottom here. And then when we got above that trend line, that was a great indication that we were probably moving higher. And we did for some amount of time. We put in a peak. Market comes down, gives us a second point, a third point, draw the trend line, extend. I mean, you guys get the idea. So we can do it both. If you're trying to identify downturns, you're connecting tops and drawing the trend line and extending it out. If you're trying to identify uptrends, you're connecting the bottoms and drawing the trend line. So the most recent, since the October low, overall, the trend has been up, but it's been up in 3 really obvious sections. So we had the low in October. If we connect these 3 points, and then we have this breakdown, right? Same thing in the middle rally, 3 points and a breakdown. And where we are right now is the first point, the second point, the third point, and again, another breakdown. Came back up and got hit resistance at that trend line and rolled over. So the trend lines are kind of always a work in motion. So right now, we have a pretty significant breakdown below that trend line. So from that perspective, the expectation is that we create some kind of new downtrend here. if the market was to come back up and start moving higher, this would be the first point, or this would be the first point, this would be the second point, and we would change the trend line to be something like that, right? So they're constantly kind of a work in motion, and you once you can establish the first trend line, you draw it, and as price affects it, you can redraw the trend lines. But trend line analysis is a really, really useful tool. Okay. So bonus chart is going to be the S fund head and shoulders. S fund, we were talking about it last week. If actually, I think I talked about it in the newsletter. It's great that the C fund is moving higher, but if the October low is actually the low, the S fund, which is small cap tech, should be leading us higher, and clearly that's not happening. So here we are at the top of the S fund. We have a daily chart. Top of the S fund was actually in late 2021. Price comes down, and we had an October low, and since then it's pretty much moved sideways, right? And so one of two possibilities is going to happen in the S fund. Either we're in this kind of long-term horizontal channel, right, which is identified by the dotted lines. If that's the case, price can come down and be range bound between the upper and lower channel lines for some time before it breaks either to the upside or to the downside. And so anything that happens in between here is just movement. It's volatility, and so it's possible that you could play it because the range is really it's a really big range. So even given our TSP 2 moves a month rules, we could still play this this movement within this range. But really, what we want to watch for is either a break out of that range to the upside or a break down to the downside. So that's the first possibility, is that we're range bound in that horizontal channel. The second is this head and shoulders pattern that's a little bit shorter term that the S fund is setting up. So a head and shoulders is left shoulder, head, right shoulder. Okay. And you connect what's called the neckline. And if you break the neckline to the downside, price goes down. Okay. It's a really, really strong pattern. And theoretically, the price target, if a head and shoulders top, which is what this is, head and shoulders top, when the head and shoulders top completes, the price target is the distance from the top of the head to the neckline on the downside. Right, so price would fall pretty far to get to that target if it does break that neckline. So that's kind of the worst case for the S fund. So you have the head and shoulders, or price could just come back down and back into that channel, before moving higher. So head and shoulders pattern is really good to kind of keep an eye on. That would be the worst case. Kind of the best case is if we came back down here, got support at that channel, and moved back up to the upside. So that's kind of where we are on the S fund. But the big problem again is that if this October low in stocks is real, the S fund has a lot of work to do to catch up to the C fund, and it's not happening right now. Okay, so the TSP weekly fund charts. Again, I'm recording this on Friday, and so this chart only takes us through Thursday, May 4th. The market is definitely up this week, so the candle isn't going to look as bad as it looks right now, that red candle. It does look like we're going to get support at that 20-week moving average line. So it's unlikely that we recover all of the losses that we have had this week so far, but it does look like we're going to get support. And so that's a good thing. As long as we can stay on a weekly basis above this 20-week moving average line, then the line keeps moving higher, and price keeps chugging along higher. RSI, as of Thursday's close, it's just barely above 50, and it's declining, which is not good. MACD looks like it's starting to roll over. So, but again, if Friday price can stay up there, as of this recording, it's up about 1.5%. So that would definitely be support at that 20-week moving average line, and we'd still be in pretty good shape. Okay. S fund. Clearly, so for the last 3 weeks, we've been below that, at least 3 weeks, 5 weeks, we've been below that 20-week moving average line. RSI, it's been kind of stable, but just below 50 and now declining. And MACD is pretty much flat. So there's not a lot of momentum behind any of these moves on a weekly basis. But it definitely doesn't look like the S fund is in any position to all of a sudden roll over and start moving higher. It really looks like the S fund wants to break that trend line to the downside. And kind of like the C fund that we talked about on the longer term chart, what is the most likely possibility is an A, B, C, where this length is the same as this length. And so the S fund could put in a pretty significant decline by the end of the year. Okay. I fund certainly is the best of the stock funds, but it's topping out. And so we have a pretty, let's see, 4 weeks. It can't get above this resistance level now, and starting to roll over this week. So the I fund has been holding up the best, but RSI is rolling over. MACD, we can see, is much weaker than this move. So the beginning of this rally was really strong, but this last part of the rally, it's much weaker than the first part, which just tells us to anticipate a top. It's not an exact timing tool, but it's definitely telling us that this move off of support is nowhere near as strong as this first part of the move was. So it's looking like the I fund is kind of petering out, is what I'm saying. F fund, still, we've been talking for a long time that the expectation is that stocks crater this year and the F fund rallies, and we're just not seeing it yet in the chart. I mean, we had a big move, just like the stocks, we had a big move off the bottom from October, but then the F fund has been basically flat. And now it's consolidating to that 20-week moving average line. Not really, it's got a clear resistance up here. Ideally, it gets above that August high at 102, and then the F fund is really moving higher. But right now, it's kind of range bound, and this is not a great look. So we'll have to see what happens with the F fund. So yeah, between all the three stock funds and the bond fund, we don't have a really good direction right now. We don't have a good kind of trend that we can set it and forget it. And so until we get that, really the G fund is kind of the place to be. All right. That is all I got. Hopefully you guys got something out of this recording. We will be back in Virginia next weekend and back to the podcast as we usually do it. All right. Hope you guys had a great weekend, and we will see you next week.